Welcome back to the Deep Dive. If you've been keeping an eye on the Canadian housing market, especially as we head into 2026, it feels, well, less like a market and more like a high-stakes economic battlefield.
It really does.
You dropped a fantastic stack of sources on us. 7 leading economists, analysts, investors, and they've each given their key charts and forecasts for the year ahead.
Yeah, some really sharp insights in there.
So our mission today is to grab those high-level predictions, cut through the noise, and really just distill it all into a clear forecast for you.
And we're not just talking about, month-to-month price swings.
No, not at all. We are analyzing the deep fundamental movements that are kind of resetting the entire structure of Canadian real estate.
That's the key word, right? Resetting. The sources are pretty extraordinary because they signal a multi-year economic rebalancing that goes far beyond any short-term cycle we've seen before.
Okay, and when we dive in, where are we focusing?
We'll be hitting 3 main areas. First, these unexpected, almost seismic shifts in demand. Then, massive new dynamics on the supply side. And finally, the ambitious and sometimes conflicting federal policy goals that are driving this whole thing.
Okay, let's unpack this. And if there's one overarching takeaway that just jumps out at me, it's how fundamentally the whole narrative has shifted. The economic factors that spent a decade driving Canadian housing prices into the stratosphere, they've now either completely normalized or in some cases reversed course entirely.
Exactly. And that reversal changes the trajectory of, well, everything we're about to discuss.
So let's start there, in that place of reversal, this long-awaited correction. Robert Kavachit from BMO Capital Markets has been saying for a while now that this correction would be measured in years, not months.
He's been calling it since early 2022, and his original thesis was that the correction had to be deep because the market drivers pushing it up were so aggressive.
And now those same drivers are coming undone.
They are. First, you have real borrowing costs. For years, they were deeply negative. Inflation was outpacing interest rates, which just fueled speculation.
Right.
Now, those costs have normalized. People are actually paying a real price to borrow money again.
And what about the psychology of the market?
That's the second piece, that fundamental expectation of speculative growth, the belief that Canadian housing prices just, only ever go up. That's been largely erased.
Okay, and then demographics.
Yeah.
We've talked so much about the millennial generation as this huge demand engine.
That's a huge shift, and it gets overlooked when we just talk about interest rates. The sources point out that the largest group of millennials is now aging out of those prime first-time home buying years.
Moving into their late 30s, early 40s.
Exactly. So that demand velocity, that scramble to get a first home that we saw 5 years ago, it's naturally slowing down as that population moves past the entry-level phase.
So this isn't just a cool down from the Bank of Canada. It's an entire economic ecosystem being forced to structurally reset.
Precisely. This whole long process is a fundamental resetting of valuations from both an affordability perspective and, crucially, an investment perspective.
So housing is no longer seen as that guaranteed path to wealth.
The easy money is gone. And according to the analysis, this whole structural reset is, and I'm quoting here, not quite done yet.
That reset in valuation leads us right to the demand side, where we see some truly dramatic shifts. David Doyle at Macquarie Group has this remarkable chart he calls the household game.
Yeah.
It suggests a monumental pivot from the last, 30 years? What's the change he's forecasting?
This is, I would argue, the most critical and surprising forecast in the whole stack.
Okay.
Doyle points out that for 3 decades, Canada's housing stock grew pretty much in line with new household formation. But now projections based directly on the federal government's immigration policy shifts imply, get this, 0 household formation over the next 2 years.
0. Stop right there. In a country that has relied on population growth to fuel its economy, that is a monumental slowdown. Why does a shift in immigration policy translate to 0 new households?
It's because the policy specifically targets the reduction of non-permanent residents, or NPRs, temporary foreign workers, international students.
The groups that are most likely to form new, smaller households when they arrive.
Exactly. They're the ones renting a first apartment, moving to a new city. By putting harder caps on that specific group, the analysts conclude that the traditional engine of household demand has, for now, completely seized up.
That creates a huge supply-demand imbalance, especially with all the construction we've seen. So what happens when that pressure cooker of supply meets 0 new demand?
Well, the sources suggest it corrects itself in one of two ways. Either we see a huge drop in construction activity, canceled projects across the country, or we see a genuine restoration of housing affordability
Ooh, what, prices coming down further?
through continued price declines
Yeah.
coupled with income growth. Yeah.
But I want to stick on something you brought up because it seems so counterintuitive. Yeah. The idea that analysts see this slowdown as potentially positive for Canada's long-term growth. How?
It is counterintuitive, I get that, but it's about capital reallocation. For years, so much of Canada's private capital was just funneled into residential construction and housing speculation.
Right.
The argument is that this demand shock forces that capital to shift away from housing and toward more productivity-enhancing projects. Investing in tech, in manufacturing, things that actually boost Canada's long-term economic output.
So a painful correction is being framed as like a necessary economic intervention. But what about the short-term pain? A decline in construction means job losses.
And that is the essential tension. The analysts are forecasting a long-term benefit, but the sources are very clear that this shift means real contraction and real difficulty for the construction sector in the near term.
Okay, so let's pivot to the ground level because Brian Yu at Central One Credit Union says we have a two-speed market right now. Where are these pressures actually playing out?
Well, the sources show the large pricey markets. Vancouver, Toronto, Calgary are really struggling. Low sales, declining prices. The speculative froth is just gone.
But other parts of the country?
Other parts, particularly more affordable regional centers, are still seeing near-record prices. That's being fueled by people moving within the country.
So what does stability look like then?
Yu argues it requires a big decline in all the resale inventory that's ballooning right now, and critically, a reduction in the number of new unoccupied units sitting on the market. That's the inventory that's really putting downward pressure on prices.
That inventory buildup leads us perfectly into our next section, which is this huge paradox. Construction is still surging even as demand signals are flashing red.
And this is where Bradley Saunders at Capital Economics brings up the build-to-rent, or BTR. Boom.
Okay, explain what that is. Because BTR isn't the same as building condos.
No, it's very different. BTR refers to purpose-built rental buildings. Apartment towers constructed specifically to be owned and managed by large institutional landlords, not sold off as individual units.
So why are developers chasing these huge BTR projects when condo sales are weak and immigration, the main source of renters, is collapsing?
It's a policy response, plain and simple. The immigration flows are a major headwind, yes, but cheap government-backed financing is just keeping this trend going.
And the data on this is pretty wild.
It is. For the first time on record, BTR starts actually surpassed the combined starts of new homes and condos in the third quarter.
And the CMHC connection is key here.
Absolutely. The CMHC, the Canada Mortgage and Housing Corporation, estimates that a staggering 88% of these BTR projects got a low-cost construction loan or loan insurance program in 2024.
Wait, 88%? That's incredible. So what does that program actually do for a developer?
Essentially, the federal government is acting as the ultimate backstop. It dramatically lowers their borrowing costs and removes the high interest risk on these massive multi-year projects.
So even if the market looks soft, the cheap financing makes the project viable.
Exactly, especially since they're building for a long-term rental portfolio, not a quick sale. And analysts think this has a little further to run, partly because PM Mark Carney's administration has largely left his predecessor's housing policies, including these programs, untouched.
This is where the sheer scale of the supply coming online becomes staggering. Ben Ravidu's analysis, The Rental Wave, paints a picture of a flood.
The volume is historic. Rabideau notes that nearly 180,000 purpose-built rental units are under construction right now.
180,000.
That's enough supply to lift the entire existing national rental stock by more than 7%.
And that's a colossal wave, and it's not evenly distributed, right?
Not at all. The surge is highly concentrated. BC, Alberta, and Atlantic Canada are all looking at double-digit increases to their rental inventory. And this wave is arriving just as population growth is expected to slow to near zero through 2028.
So if you connect those dots,
you get a forecast where Canada's national rental vacancy rate, which has been super tight at around 2.3%, could climb to levels we haven't seen since the early 1990s.
Which would be? What kind of number?
We could potentially approach an unprecedented 5% nationwide.
Wow. A 5% national vacancy rate would fundamentally change the game for renters in this country. A huge shift.
Enormous.
Okay, let's move on and look at affordability and government policy. Robert Hoke at RBC Economics notes that while we've had some minor relief since early 2024, future improvement will be slim. Why so narrow?
The big obstacle is the Bank of Canada. It's likely to hold interest rates steady through 2026. So even with some price relief, the cost of servicing a mortgage remains punishingly high.
So demand will just be a very slow crawl back up.
A very gradual crawl, yeah. And it's complicated even further by those sharply lower immigration numbers we talked about.
And beyond just housing, we have to look at the bigger economic picture. Arlene Kish at S&P Global Market Intelligence brought up Prime Minister Carney's 2025 budget. What's the goal there?
The budget is really focused on strategic trade policy, specifically trying to lift industries like manufacturing that have been hit hard by high U.S. tariffs.
Trying to diversify away from the U.S. market.
Exactly. The long-term strategy is about laying the groundwork for trade deals that could double non-U.S. trade over the next decade.
Okay, that's the macro strategy, but let's bring it back to housing, because the government has also laid out this massive, almost unbelievable production goal.
It's huge. The target is building between 290,000 to a maximum of 480,000 units per year, every year, through 2035.
480,000 units a year. That is an astronomical number. How do they possibly plan to execute that if the market is so slow right now?
The strategy all centers on achieving this through a more productive home building industry with fewer barriers and less red tape.
More productive. What does that actually mean?
Well, the analysis points out that greater productivity in any industry implies you have to increase your output with less labor used per unit over time. They want to streamline and automate home building.
And that ties directly back to what you said earlier about the pressure on goods-producing sectors.
Exactly. We already see soft labor demand in construction and manufacturing because of weak consumer demand. Job vacancy rates are near historic lows. So the demand for this kind of labor is already expected to be soft even before this massive government push for productivity and less labor input fully kicks in.
It's a very complex situation for employment.
Very.
Okay, let's bring this all back together for you. This deep dive has really defined a multi-year correction through the tension of two huge opposing forces hitting the market at the same time.
That's right. On one hand, you have this profound policy-driven demand collapse that zero household formation forecasts.
And on the other hand,
An accelerating supply bomb, fueled by federal financing, resulting in this unprecedented build-to-rent and rental inventory boom. The confluence of these factors suggests both prices and rents are under long-term pressure.
so what's the final takeaway for you trying to understand Canada's economic future? It seems to be a structural vote of confidence, even if the housing market is going through this really painful correction.
What's so fascinating is how the sources repeatedly frame this painful short-term shift away from housing speculation as a necessary transition, a move toward more productivity-enhancing projects for Canada's long-term growth.
A National Economic Rebalancing Act.
That's what it is. It's hard to watch in the short term, but it promises long-term benefits if it's executed successfully.
That's a powerful final takeaway. But let's leave you with one final, provocative question to think about. Given the government's dual goals, massively ramping up housing production to 480,000 units a year, and that simultaneous push for greater productivity, which means using less labor per unit, how quickly can that new stock hit the market without leading to a serious short-term employment crisis in that already soft goods-producing sector?
That's the question.
That trade-off between affordability and employment is the delicate balance to watch in 2026. Thanks for diving in with us.